makers and market movers. This is The Pulse with Francine Lacqua.
A very good morning and welcome to The Pulse. I'm Manish Cranny in Dubai. What's coming up on today's programme? Well, Chinese authorities have asked some investment funds to avoid being net sellers of equities as the right deepens in the country's financial markets. More weak data from China pulls Asian stocks lower for a fourth session. UK inflation remained higher than expected last month, with climbing costs for travel and holidays. Investors now bet on further rate hikes from the Bank of England. And Neil Kashkari says the Fed is a long way from cutting rates as US retail sales show consumers are alive and kicking. A very good morning to you. Good afternoon if you're tuning in from Asia. This is The Spectrum. Europe is suffering immunity from the China angst and woes. Look at that. The European map is still just eking out some gains. I can tell you this. Volumes are 33% below where they are normally at this time of year, as we see growth outlook for China being slashed by JP Morgan to 4.2% next year. Immunity at the moment. I had Jane Foley with me this morning talking about a lower euro on the back of the exposure. The exposure is Europe to China, not US to China. And our headline is, of course, there's more angst in shadow banking. The authorities now ask China to some funds to hold back on their equity sales. This state of play, natural gas is ramping higher in Europe. Market jitters really about Australia. Australia, 10% of the liquefied natural gas market is in Australia. We've got walkouts and we have people on strike down there. So we saw the market explode higher by some 15%. We've come back now and dropped. Wheat is on the up. We put that in there for you, up 0.8%. There's been attacks on the Danube overnight, again in the Odessa region. So there are concerns about supply there. Now, 10-year yields are falling. We'll get to Valerie Teitel in just a moment. Now is the time, according to Stephen Major at HSBC, who says, go up that curve. Get yourself long those bonds. 30-year paper, by the way, for example, above the level that we saw in 2011. You're looking at this year's highs on 10-year paper, but we are trickling back down. And cable trades at 127.41, up 0.2%. I would say a fairly muted reaction to an inflationary narrative, which some would say is stuck and perhaps even in a spiral. We have the worst inflation in G7, CPI 6.8%, and that is something to be concerned about. Let's focus in on 10-year paper, 30-year bonds. They rose to the highest level since October yesterday. We had those stronger than anticipated retail sales for July. That reinforces the narrative that the Fed may have to raise rates further. Valerie Teitel is with us. So, Valerie, we saw this spike and now roll on some of these yields. The narrative is the Fed may still have more to go, according to Kashkari, but there is also the narrative building by some of the major houses, Stephen Major being one of them. Now is the time to enter the valley of duration. Good morning.
Good morning, Manus. Yes, a lot going on in the Treasury market. My eye is surely squarely on where these real yields are going. It really was that retail sales beat that drove a lot of the move yesterday, because retail sales, Manus, feeds directly into GDP. That controlled group feeds directly into GDP. Consumers make up 2/3 of GDP spending in the U.S., which is just boding ever well for this third quarter GDP print. We saw JP Morgan seeing upside risks already to their third quarter call. And the Atlanta Fed now, their GDP forecast for the third quarter is now on a 5 handle. So this U.S. economy isn't turning, I guess, negatively anytime soon. That's what the data told us yesterday. And back to Stephen Major's point on maybe now is the time to go long the bond market. I would say the I guess, opposing argument to him is if the U.S. does enter a recession, if we do get this growth slowdown, normally what comes alongside that is a surge in government spending and a surge in Treasury supply. If you do think that this latest real yield move has been more driven by supply and demand dynamics more than anything else, perhaps actually we could enter a recession and see yields not fall as much. Yes, they would rally in the front end if we price in Fed hikes, but if more government spending is on the cards, if a bigger and swelling deficit from the U.S. government is in the cards, that could keep the longer rates, longer yields in the Treasury yield curve quite supported.
Okay, well, two sides to a market. And Major's note this morning, of course, talks about making the case for the man of straw. Valerie, thank you very much. Valerie Taital. So we've had more data from the United Kingdom. The annual inflation rate fell last month, but less than expected as the cost of travel and holidays climbs. The latest figures add to the case that the Bank of England may have to raise rates again. But some Treasury advisors are concerned that the Bank of England is at risk of overdoing it and pushing the UK into an unnecessary recession. Let's speak to the government minister now. Gareth Davies joins me now, the Exchequer Secretary to the UK Treasury. Gareth, thank you so much for joining us. I mean, if we look at the last 24 hours, wages growth blows out by a record amount. You're looking at services inflation, the highest since 1992. Are we losing control of the inflation narrative? Are we in some kind of a doom, sticky loop on inflation? Good morning.
Well, good morning. Thank you very much for having me. Today's figures, as you were reporting, for inflation has come down significantly. I think that'll be met with some relief by a lot of families and businesses across the country. We've seen a significant reduction. I think it's the lowest level of headline inflation since February last year. But as you allude to, we're not out of the woods yet. We've got a long way to go and we've got to stick with the plan. I think inflation reached nearly 11% last year, and while it's come down significantly from that point, it's really incumbent on the Treasury, on this government, to stick with the plan, to make sure that we're making responsible public finance decisions and that we make sure that fiscal policy is aligned with monetary policy at our independent Bank of England. We'll continue to do that, and we're certainly not complacent despite the significant reduction announced today.
Look, yes, it has dropped. There's no doubt about it. But you have the worst inflation in the G7. The Office of Budget Responsibility says that you're in a very tricky footing at the moment. Is this government prepared to go further and cut services, cut costs? I mean, the OBR says you're going to need to do tax rises and cuts equivalent to 4.4% of GDP. Is there a political palatability to do that to tame inflation?
We've got a plan that includes ensuring that inflation is our number one target, in terms of priority for the Prime Minister, getting that down by a half this year. Most of the forecasters believe that we will see that happen. The IMF, OBR and Bank of England all expect inflation to come down significantly this year. You talk about other countries, it is a global phenomenon driven by post-pandemic situations on supply chains and, of course, the war in Ukraine. So we're not alone in having high inflation. It is coming down. We need to stick with that plan. One of the things that we can do is ensure that our fiscal policy is aligned with the Bank of England's monetary policy. That means taking tough decisions when it comes to public sector pay, for example. We've taken action to hold down energy prices with frozen fuel duty. So we are taking what the IMF have called decisive action. We just need to keep going with that and we'll see inflation come down overall.
Andrew Bailey, you talk about alignment between monetary policy and fiscal policy. Andrew Bailey has made it clear that higher inflation or inflation spiral, as it would appear that we are in, is going to mean higher rates from the Monetary Policy Committee. Are you concerned that higher rates could invoke a pretty hard landing, a recession?
Well, nobody wants a recession. We've been very clear that critical to ensuring that we can grow our economy and avoid a recession is to get inflation down. And the Bank of England have been clear that in a year's time, if we stick with the plan, inflation will be around 3% while avoiding a recession. We've seen a major upgrade to our growth forecasts by the IMF, OBR and the Bank of England. You know, I remember not so long ago, a lot of the forecasters were saying that we would enter a recession by now. That hasn't happened. But we do need to ensure that the driving factor here is getting inflation down. We do need to align fiscal policy, as I've outlined, with the Monetary Policy Committee's decision on interest rates.
What does that actually mean?
What
does that actually mean in terms of aligning aligning your fiscal policy. It's a very broad, grandiose term, if you will allow me, but it means something a lot more severe, doesn't it, Gareth?
It means the action that we've already taken, for example, the energy price guarantee, which held inflation in energy prices. The OBR said that that would knock about 2% off inflation by holding the duty on fuel, for example. You know, we've seen fuel inflation start to come down. It's taking that part, you know, the decisive action on those factors, while also not making decisions, not taking action that would exacerbate inflation. For example, by increasing borrowing and spending at unsustainable levels, by making decisions on taxation that would fuel inflation. So it's part action that the IMF have said is decisive action, while also making sure that we don't exacerbate inflation. That's what I mean by aligning the tough decisions that we've got to make in the Treasury with the tough decisions that the Bank of England are making on monetary policy.
I look at debt to GDP. Your debt servicing costs are exploding, as are other nations around the world, before you caveat that for me. But debt to GDP is over 100%, Gareth. We haven't seen that since 1961. There hasn't been much achievement in terms of reducing that. I suppose the question that we here have got to ask you is, are we in a more perilous position for the government bond market of the United Kingdom than we ever were under Liz Truss? I mean, this is a fairly brutal statistic for you to deal with. Are you concerned about a strike in owning UK government debt with these debt to GDP numbers and it's worsening?
Well, you're right to point out the level of debt that we have in this country, but it's also important to highlight what has caused that high level of debt. We had a global pandemic shock to our economy, which required the Treasury to step in with hundreds of billions of pounds of support to ensure that businesses and individuals and families could get through the worst of that crisis. And then we came out of COVID to have an energy shock caused by the first war in Europe for decades. So we've stepped in with about £94 billion of energy support for businesses and individuals as well. So it's no surprise that debt is high. What we've got to do now is get inflation down, make sure we can grow our economy, invest in our people, garner business investment to get that economy growing, so that we can get the debt down. We are not complacent by any means. You're right that other countries are facing the same dynamics, and they are because these are global factors that have caused this situation. We've just got to keep going with our plan to act responsibly when it comes to public finances and make sure that we're boosting investment wherever possible.
Gareth Davies, Exchequer Secretary to the UK Treasury, thank you for joining me this morning. Coming up on the show, Norway's sovereign wealth fund returns over $140 billion in the first half. We look at how it got back on track following one of the worst years in history right here on Bloomberg. Norway's sovereign wealth fund has seen a 10% return of $143 billion in the first half of the year, driven by tech. The gains there indicate that the fund is back on track after one of the worst years. Its largest holdings are Apple, Microsoft, along with a number of huge tech names. Now, it chimes with Bank of America, the survey there, which found that global fund managers are now the most overweight technology since December 2021. Hannah Gooch-Peters, global equity investment analyst at Sanlam Investments, challenges that base case. Ms. Peters, good morning. So the rest of the world is long, and long can be on tech. But you have a warning on mega stock trends. You're a little bit suspicious. Can you qualify that for me?
Morning, Manus. Well, I think that when you've seen such a dramatic move in many of these names, of course, the largest names in the world, they're all trading on very expensive valuations. And I think now is the time to be cautious. I think many investors have long forgotten the pullbacks that we saw last year. Of course, names like Microsoft, like Amazon, for example, had dramatic pullbacks last year because they were all trading on exceptionally high valuations. And I think that if you are now trading on a, say, 3.5% free cash yield in this environment, I think now is the time to just be cautious and perhaps reduce those positions, which is what we've been doing.
Bill Gross was pillorying the bulls in the bond market and lambasting the bulls in the equity market. And he said, look, the premium, the equity premium is not there. Do you think that there are cracks and fissures, as it were, appearing in the yield in equities relative to bonds? Does that have any merit for you in your world? I'm just going to grab the chart for the dividend yield to bond yield. Are you with Bill on pillorying the bulls?
No, I completely understand the argument, but I think also those investors that have been invested long-term in bonds, unfortunately, especially due to last year, haven't done particularly well in terms of returns. And I think in an environment where you've also got inflation, those real returns can be a challenge. And on a headline level, yes, the equity market does look expensive, particularly in the US. And like we said before, that's largely driven by those large cap names that are trading on those high valuations. But this is the time to look under the hood, underneath that headline level, and you'll see that because we've had such a bifurcation in returns this year, that there are actually some really exciting growth opportunities coming out at more reasonable valuations in those names that have lagged those large sort of headline numbers that have really driven the market. So yes, on an overall level, equities versus bonds not looking quite so appealing, but underneath the hood, underneath that headline layer, I think there's some really exciting opportunities out there.
Look, we're getting more and more. There is the equity risk premium, by the way, relative to bonds. And as you can see, that is coming back to the average level and indeed below that. Let's shift our narrative to China. I mean, we've written a great deal. Fitch may reconsider the credit rating. There's concern now, there's narratives and instructions to the asset management community, don't sell as many equities. There's concerns about shadow banking. There's concerns about retail sales, concerns about fixed asset investment, concerns, I could go on. And yet you are quite bullish. Long-term growth, 30%. New room for pipeline, 6% compound growth in cash flows, etc. You are more bullish on China than the headlines are at the moment. So what is it? When all the rest of us are fearful, you're greedy?
So I think the example you're using there, of course, is Intercontinental Hotels Group, which is a UK-listed business, but it's got, we think it's going to have about 30% of its new room exposure in China. What we've noticed in the market is that the Chinese market is about flat this year, if you look at it in dollar terms. We've seen some massive pullbacks, of course, last year exceptionally weak. There is, again, a huge difference in returns between those companies that rely on China as a growth engine, and Intercontinental Hotels Group is one of them, for example. But other examples would be something like L'Oreal or Louis Vuitton. They have China as a growth engine. They've done exceptionally well this year. So those companies that are actually listed in China, there's been a lot of weakness around there, I think, due to the sentiment. But companies that are reliant on that growth engine are actually doing really, really well this year. There is a huge difference, though, you have to be very careful with your stock selection, I think, when you're looking at China. A company like NetEase is up close to 40% this year. It's an exceptionally high-quality company looking at that growth in online, that mobile gaming, but then you've got to stay away, I believe, from real estate and from banking exposure in particular in China.
And sorry, I misrepresented that, of course. I should have qualified it and said that there are names, and you quite rightly corrected me, IHG being one of them, which has a huge China exposure. But when you see those mega macro headlines on China, do you think people, how do you think the reaction by Europe, for example, Europe's quite steady this morning on really gushing headline after headline after headline, which is fairly turgid on China. Why the immunity or impunity, if one can use that phrase at the moment, on equities to what's going on in China? Do you think positioning is light in China?
I do think positioning is light in China. I, too, was also surprised by the sort of strength in some of these names, particularly with their Chinese exposure in Europe this morning. I think that there is a lot of weight put onto where companies are listed, and that's something that we really try to ignore, to be honest with you. We're looking for where companies generate their revenues, and I think that's what's really important. And like I say, companies like L'Oreal, like Louis Vuitton, have this massive Chinese exposure, sort of 40-odd% of their revenues, and it's a real growth engine for them going forwards, but they are trading on exceptionally high valuations. They seem to be immune more so to this Chinese, to the bad news in China. They're looking through that. And I think that sort of bad macro vocabulary, if you like, can actually be a good entry point into names. I think we have to try and look past short-term news and invest in companies that have that long-term structural growth opportunity.
Hannah, thank you very much. Hannah Gooch-Peters, the global equity investment analyst over at Sanlam Investments. Norge Bank Investment Management, I should say, the CEO, Nikolai Tangen, will be joining the TV team, the Bloomberg TV team. That's 1:15 UK time, right here on Bloomberg.
Yeah, what we have done over the last half year is indeed to raise the prices in line with the cost inflation we encountered. We have done that across our territories, but especially, of course, in Europe. And hence you see a net revenue per hectoliter, which is roughly 10% higher than before. And by that we have been able to ensure that we would remain to have the gross profit that we needed in order to further develop our business and also to invest further in our brands.
The Carlsberg CEO there after the brewer said consumers are still paying up for premium beer. Chinese authorities have asked some investment funds to avoid being net sellers of equities as the right deepens in the country's financial markets. More weak data from China pulls Asian stocks lower for a fourth session. European stocks fluctuate. UK inflation remained higher than expected last month, with the climbing costs for travel and holidays. Investors now bet the BOE rates are steady. And Neil Kashkari says the Fed is a long way from cutting rates as US retail sales show consumers are alive and kicking. A very good morning. Welcome to the Pulse. I'm Manish Krenny in Dubai. You've had blowout inflation numbers in the United Kingdom, and that really is something for us all to consider. Well, the Chinese shadow bank, Zhongong, has missed payments on dozens of products, indicating troubles at the embattled lender are even deeper than previously known. The firm's liquidity challenges underscore the problems in the property sector, where new home prices in China have dropped for a second month in July. Joining me now is our China government and economy editor, Jill Decies. Jill, look, there's lots of headlines coming across here now. Talk me through the scale of the unfolding crisis around the asset management and shadow banking at the moment.
Yes, Manus. So ultimately what you really have to remember here is that this trust industry within China, this is a $3 trillion industry in China. And a lot of the concerns that are unfolding both at this bank, which is affiliated with a much larger one, is that it's sort of creating this idea that there could be potentially some contagion risk from a lot of what we're experiencing in the property sector right now, sort of spilling over into the financial sector. So as we understand it, some of payments affiliated, or some of the investment products affiliated with these companies, these trust companies, are related to real estate. And then, as we know, real estate problems within China have been at this point a years-long concern, and really kind of worsening within recent weeks and months. I mean, we've been spending a lot of time on this program and other programs talking about a lot of the problems at Country Garden, one of the nation's largest developers, which is experiencing its own liquidity crunch. And then we also know that there's these continued issues playing out across the housing sector at large. We just got some pretty weak home price data out of China this morning, some very weak property investment data yesterday. So all of this kind of combines to tell us that we still have these really, really deep-seated concerns about not just the property sector, but also how it's kind of spilling over into potentially other industries, as you see here.
Now, look, I mentioned it through the show. You've got JP Morgan downgrading growth this year and next year, 4.2%. Barclays also slashing their growth targets for China. How much of that is new information? What is it in these downgrades that perhaps I need to focus on more closely?
So look, Manus, I think the important thing to remember here is that, with these downgrades, JPM going to 4.8%, Barclays going to 4.5%, we're starting to see economists consider that China might even miss what was ultimately considered a very conservative growth target that they set earlier this year. Remember, back in March, a lot of economists were even more optimistic about what the state of the economy looked like, what growth would look like through 2023. JP Morgan at one point, I think, had a growth estimate of 6.4% for this year. Now you're starting to see these banks kind of slide under what the growth target was for the government. I mean, maybe that indicates that, the government in setting that conservative target was trying to pace everybody this year in terms of what the extent of the scale of stimulus would look like, how all of that would unfold. But I think now we're starting to see some fears over whether, we can really hit those targets, how we have to reorient our calculus around China, and then ultimately how we have to kind of keep in check our expectations for support and further stimulus this year.
Okay, Jill, thank you very much. Jill Decies on the China growth downgrades. Let's turn our attention to the crypto market. According to the latest Bloomberg data, Bitcoin's 90-day vol has dropped to the lowest since 2016. It's an unusual stretch of calm for the digital token. It's hovered around $29,000 throughout most of August. Let's get to Adam Back. He's the chief executive, the co-founder of BlockStream, a leading provider of blockchain technology. And famed in your world, famed in the Bitcoin world. What will rock me out of this slumber? Volatility, the lowest since 2016. There's a deafening silence. What's going to rock Bitcoin above or below the 29,000 level? Adam, good morning.
Good morning. Yeah, I mean, I guess August is a quiet month in Europe. Lots of people on holiday. But yeah, I think Bitcoin tends to surprise people by, they get bored and then suddenly something dramatic happens. So I think just leave it a while and something will happen.
Well, event risk is always there, isn't it? There's a halving event to come, probably in the spring of next year. What impact will that have?
Well, I mean, it's something that there's some debate about whether it's priced in the market. Some people will say, oh, it's priced in, but I think because of the generally high volatility, other than the last month, it's quite hard to price in. And it also punctuates the 4-year halving cycle, sort of economic cycle of Bitcoin. And historically, Bitcoin's done well. Within 6 or 9 months after the halving, there's been a sort of price appreciation part of the cycle. Now, this time,
so what do you think is possible?
Well, I think it's possible that we get to, a new all-time high, like 100,000 or more, even before the halving, simply for the reason that the last few years have been kind of a depressed market in general and in the crypto market through, a number of bankruptcies and DeFi failures, things like that.
Do you really think $100,000 is achievable in Bitcoin before the halving event? There's no fear that you're very resolute on that?
Yeah, I mean, actually, I infamously took a small bet with somebody on Twitter on that. It was just some conversation about whether it would happen or not. And this fellow said, well, let's bet on it. So I let him pick the price. And so we're on. Let's see if it happens.
You got skin in the game. Good man. Look, your company, you raised $125 million. You come from the mining industry, the mining sector. $125 million, do you need more money? What are you going to do with that money, briefly?
That was just the latest fundraising activity. In total, we've probably raised about 400. We've been around since 2014. So it's primarily, well, there's two parts of it. One is layer 2 Bitcoin technology, like Liquid, which is a securitization layer for Bitcoin, and something we issue investment products on. And the other part is hosting. So we provide hosting for institutional miners. So people like Fidelity, we host all of their miners in our facilities. It's kind of like co-location for mining, people doing mining at fund level.
I mean, just on that mining narrative and the facilities they're in, do you see a continued bottleneck in terms of the infrastructure in mining? Where are we in that cycle?
Yeah, I mean, actually, that's the subject of an upcoming financial product from BlockStream. But basically, going back a couple of years, there was a shortage of miners going into the Bitcoin bull market because the price appreciated, mining profitability appreciated, and the manufacturers couldn't produce them fast enough. At this stage in the cycle, there's actually a surplus of miners and a shortage of ready-to-use hosting infrastructure. And you have to bear in mind a lot of the Bitcoin ecosystem is underfunded, undercapitalized. So people are using leverage, which tends to exacerbate volatility as well.
Now, I said that you're famed in your own world, and of course you are. You're one of the original gangsters. I think that's what you referred to. What we're all curious to know is obviously Satoshi Nakamoto apparently communicated with you in 2008. Have you spoken to this fabled person recently? What do you think he or she would make of Bitcoin now? Do you think that there'd be 100,000? They'd agree with you 100,000 is on the way? Have you communicated? Have you had any communication?
No, I don't believe he's been heard from since something like 2011, and I only communicated via email at the time. So, I mean, I guess we don't know exactly how many Bitcoins Satoshi has, but it would make him, you know, probably one of the 20th wealthiest people in the world at that kind of price.
Okay, so radio silence. Well, he knows where to catch you. You're obviously making bets on Twitter. Well done. Good to have your call this morning on the miners and indeed on the halving event and where prices will go. That's BlockStream's chief executive and co-founder, Adam Back, on Bloomberg. Coming up on the show, Open Society Foundations ending most of their operations in the EU. More details behind the shift in direction by George Soros' charitable organisation, The Moves, on Bloomberg. Big tech matters. We know that. Breaking news on the Pulse. I'm Manus Cranny in Dubai. Tencent has just delivered their numbers for the second quarter. Now, the revenue has missed. So the top line revenue is a miss, 149.21 billion yuan. That estimate out there was 150, just under 152. Now, the issue is this, is that on an adjusted basis, the net adjusted income is 37.5. So that actually is a beat. In the very first flush, we dropped by over 1%. So the revenue is a miss. Value-added services revenue is 74 billion. Just digging through here, they've cut their total of employees by just over 1,700 in the second quarter. They hire 104,000 people. Just think about WeChat. Think about the platform. Think about the network that they cover. 11% growth in revenue matches the March quarterly growth. But, you know, the top line miss is small, one could say that. We have an MLive blog for you there. Our editors and reporters are contributing throughout, dissecting the numbers from Tencent. The stock's up 3.65% year to date. Do you want to be long tech in China? That is the question. Revenue up 11% year on year, but down 1% on the quarter. We'll leave it there. The philanthropic organization that controls most of the $25 billion of the assets in George Soros' family office is set to end most of its operations in the European Union. For more on what that means, Maria Tadeo joins me now. So this is the end of a generation, really, of Soros in Europe. Is this a downsizing? Is this a statement? How do you walk away? How do you take away the walk away?
Absolutely, Manus. And this is a very significant story for many reasons. To some extent, as you say, the Soros Foundation, Open Society, they say they will terminate their operations in the European Union this year, and the operations that they keep and decide to keep will see extremely limited funding. Now, the reason for this, they argue, is a strategic change in their priorities. A positive spin they're given to this is that, to some extent, the European Union already provides the tools and the platforms for ideas like freedom of speech and democratic values. So therefore, the funding from the foundation may not be needed as much, and they want to switch into other countries like perhaps Ukraine and Moldova. But Manus, you alluded to this. It is, to some extent, the end of a chapter here, because George Soros has a very personal and deep connection with the region, in particular with Central and Eastern Europe. Let's remember, he is Hungarian by birth. He was a big critic of communism and has been deeply engaged in the political debate in that region. So now pulling back from it, obviously, it carries a very almost sentimental to impact on this region. And we see this pulling back, which they say is strategic, again, is thin on the details, but obviously politically significant too.
Well, what are the political implications, Maria? I mean, we just had a massive graphic there, $19 billion spent, but is there a political undertone as well on this withdrawal, or scaling down? Maybe we should use the word scaling down.
Yes, and already, by the way, when you talk about the downshift and the scale down, we knew that it was happening to some extent because Mr. Soros passed on control of the foundation to his son, and we knew that job cuts anyways would happen and would take place. The significance of this is that most of the operations, in theory, would cease to exist. But it is political, as you say, because this is not just any foundation, and we know that open society and Mr. Soros himself is a real political battleground in countries like Hungary, but also to some extent too Poland, and we know there has been now for many years a political fight between Mr. Soros and the Hungarian Prime Minister Viktor Orban, who has said that he's not doing charity, that he's not doing philanthropic work, that this is a political network that tries to decimate traditional Christian values. Of course, there has been a lot of criticism about what Viktor Orban means by those traditional Christian values. So again, is that clash of the two, particularly in his native country of Hungary. The other flip side to this, just very briefly, is that a lot of the organizations and the platforms and the civil platforms that work with open societies, what they could argue is that if they receive less cash, actually that is detrimental to the values that Mr. Soros says he has stood for his life, is that, well, obviously democracy and liberal values, if you don't have the funding, it would make it very difficult for some of these NGOs and civil platforms to continue their operations.
Okay, Maria, thank you very much. Valuable insight there into George Soros's move on funding in Europe. Maria Tadeo. European natural gas futures are lower this morning after spiking in the first flush for the second time in less than a week. That's as tensions run high over the possibility of strikes in Australia that could severely tighten the global market for liquefied natural gas. Now, the discussions between European Union officials and one of the two companies operating the affected facilities yielded no firm outcome to the labour dispute. Ukraine's energy minister says the country is preparing for another hard winter as the war with Russia grinds on. It's an exclusive conversation with Bloomberg. German Galushenko told us Kyiv is expecting more inflows of gas from its European partners.
Today we could say that already something around 600 million of gas stored in Ukraine, which is gas of European companies. And that is also important for the security of supply in Europe, due to the level of storages in Europe now, because it's very high. So I think that is a good solution for the business, and that is a good solution for European security.
Do you expect more coming, Minister, from Europe?
Yeah, we expect more coming. So I can tell you that we expect average something around from 500 to 600 per month. So, and we could offer, so our storages, we need 15 BCM for Ukraine for the next season, and so 15 BCM is open for storing in Ukraine.
Can we talk about what you expect to happen this winter, Minister, both in terms of the situation in Ukraine and what you think the energy situation is likely to look like in Europe?
I think that's very important. I mean, when we are talking about the gas, there's very important instruments which already started in the European Union. That is the joint purchasing platform, which would allow not to speculate the prices and manipulate the prices. And I think that is a very important decision. Concerning the Ukrainian energy system, of course, we are preparing for another hot winter. So, and I just recall you that the previous winter, we were living under everyday massive attacks on the energy infrastructure from Russia. So it started from the 10th of October, and the last massive attacks one was on the 9th of March. So, and it was every day by all kinds of weapons. So now we are preparing for the next winter, and we are not expecting that they wouldn't shell our energy system.
The Ukrainian energy minister speaking to Alex Steele and Guy Johnson on the gas flows. Coming up on the show, some British Muslims have told Bloomberg that their bank accounts have been unexpectedly closed. We bring you more on the debanking controversy right here on Bloomberg.
timelessness and sustainability go together, right? You can't expect to be timeless if we're run out of resources. So for me, sustainability is not a side activity. It's not a reaction to external pressure. It's core to who we are, what we stand for. And to a very strong extent, it's about future-proofing our business, right? You need to focus on sustainability to recruit. More and more, that younger consumer we're talking about, they want to work for companies that care about this planet, that do more than just kind of generate revenue and profit. You need sustainability to attract consumers. More and more, including that younger consumer, they care deeply about what are you doing differently? Are you making a difference? Investors, particularly in Europe, more and more place value on what you're doing in sustainability. Many of our partners have expectations on sustainability.
Ralph Lauren CEO Patrice Louvet there speaking to Bloomberg's Francine Lacqua. And you can watch the full interview with Ralph Lauren CEO tonight, 9:30 p.m. New York time. That is on Thursday at 6:30 p.m. London time. Well, ever since British politician turned pundit Nigel Farage said that the bank account of his was shut down because of his political beliefs, the issue of debanking has been thrust into the public spotlight. However, it's an issue that British Muslims have to contend with for a while. Joining me now is our fintech reporter, Aisha Ghani, who has been researching the story. Aisha, what actually happens and when do you get debanked and just how widespread is it?
Morning. So when I've spoken to people who have been impacted by having their bank accounts shut, what has typically happened is that their account will be frozen for a few days or for a few weeks. And in that time, they have been unable to access their money in their accounts. It means that their direct debits have bounced. They are unable to pay their bills. I spoke to one man, Akil Ahmed, who was a former postman in Luton, and he was frozen out of his account for 6 weeks. And in that time, he wasn't able to pay for his groceries, and then eventually the bank did shut his account down, as well as his wife's joint account and the savers accounts of his children. Now, it's pretty widespread. We know 1,000 bank accounts are shut down each day, and it has been going up and up in the last few years.
Well, I mean, obviously the Muslim community has been hit particularly hard by this debanking. Is that fact? Where are we with the data on that?
Yes, so we know that Muslims have had less of access to financial services. We also know that most Muslims, so in terms of the people who are unbanked or don't have bank accounts, 1 in 10 Muslims don't have bank accounts, so they are particularly impacted by the lack of access to financial services. Now, over the last 2 decades, when it's also compounded by post 9/11 and 7/7, as well as hostile environment policies of the UK government, it has meant that people have been impacted by many more ways, and then having a lack of financial services also compounds this.
Okay, Aisha, thank you very much. That is Aisha Ghani on the debanking in the United Kingdom. Quick snapshot of Tencent. This is the top line for you. The revenue missed, 149.2 billion. So that's sub what the estimates out there was. But there's a couple of other lines in there which, reasons to be cheerful. I'll leave you with a cheerful note, which is, of course, the net interest income is up on the social network. So I'll leave you with one uplifting thought.